All right, good afternoon, everybody. Welcome to another installment of the PTG educational series. And today we will be discussing the PTG lines, also known as Murrey Math. And we got Module 18 today, and November 16th, 2016. Before I get started on the presentation about Murrey Math, I just want to regress a little bit and give a background of how I came about, in the trading world and how I learned trading. Some people go through formal trading programs at the big investment banks. I was not one of them. I actually entered into the trading world in a way where I was pretty much an apprentice, and I learned on the job, as they say. So with this on-the-job training, I did not have a formal syllabus to go by. There wasn't step 1, step 2, step 3. All right, it was pretty much, learn it osmosisly, asking questions, etc., etc. And fortunately, I learned from many, many talented people over the years, and which has really shaped the way I've been able to view the markets, trade the markets, etc. I've had wholesale experience, and I've had institutional big mutual fund experience, and along the way hedge fund experience, and a variety in a variety of different areas of the market. So, but through all of those stages, most of the education was never truly formalized, like you would think. I didn't go sit in classes. It was pretty much on the job. And so, along the way, I've been able to develop a particular style and management techniques and so forth, which I've effectively combined into what the Polaris Trading Group training is all about. So it's really an amalgam of a lot of things that I've learned. Now, many of you come to me here as members or guests with informal training as well, via either reading books or watching YouTubes or going to various webinars, etc. Checking out various trading rooms, all right? And it's kind of a mishmash of a lot of different things. So don't feel as though your training, is in a misstep somewhere, because a lot of what I've learned over the years was similar in the way it was presented to me. But there is, and as a result, what happens is you have all this information from all these different angles, and you don't know what to do with it. There's Fibonacci's, there's Gann, there's, of course, Murrey Math, the topic today, there's market profile, etc., etc. I mean, just numerous topics that effectively you're learning little piecemeal about, but yet you're not able to put it together. You're not able to stitch it together. And so you find that you know how to trade from certain things you've learned, but you're not been able to kind of connect the dots. And so don't feel bad. All right, it's actually natural, and many people learn that way. What I'm trying to do here at Polaris, all right, and again, we're on Module 18 here. We're kind of somewhere in between the basic and moving into some advanced topics. But what my goal is to help take the best of the best, right, creme de la creme of what I've learned, and condense it and then present it. so you don't have to go through the arduous, learning, starting, stopping, losing, winning a little bit, losing more, that frustration that sets in, everywhere. I simply want to try to fast track our members to focus in on what I have learned over the years and what works. Okay, from me being a market maker at the investment banks for a better part of 22 plus years, and then working for some hedge funds, taking the best of what I've learned and put it together. Now, the topic today will actually it will connect some of those dots, basically. Over the years, I've learned so much that I didn't even know I was doing certain things. All right. About 6 months or so, Jim Newberry, one of your co-members and a longtime friend of mine, and very experienced trader as well. All right. Again, he's helping me out with the program here. We had a conversation about Murrey math. And he basically said that of everything that you're doing, you're actually using this stuff, but you don't even know you're using it. And many of you will know that I always focus on framing out the marketplace. High, low, midpoint, and then the quartiles. So we're basically subdividing the market into quadrants, whether it's the entire prior session or if it's an individual swing from a high, low, low to high. Whatever it may be, I'm always encouraging everybody to frame out the market. And when you do that, it puts the action in context. If you have not been able to frame out the market, it just looks like chaos. And in many senses, on the very micro basis, it looks very chaotic, but it is actually very structured. And so I've been doing this and teaching this along, but what Jim kind of put forth to me, he says, what you're actually doing is a subset of Murrey math. And I didn't really realize it. Now, I am a big W.D. Gann fan from years back. I've studied all the various, Gann things and Fibonacci's and time series and cycles, throughout my career. But again, the problem there comes in, do I present cycles? Do I present time? Do I present price? What is it that is going to, best fit so the trader, you, myself, all of us can make money? Not just be an analyst. We don't get paid being an analyst. We get paid, right, by the profitability that we can put into our accounts. And so what we need is techniques, ways of viewing the markets, such that, and ways of thinking, right, using our OODA loop, that we can then take all this information, throw out all the garbage, and use the best, and then formulate a trade plan and strategies that takes advantage of the market's natural harmonic sounds or signals. Okay? So Murrey math is a trading system in and of itself, and a lot of people around the world use it in and of itself. We're going to use it and introduce you to how we use it today as part of the series of tool sets and techniques and concepts that you've already learned from us. And those of you that are relatively new with us, you'll be learning more about it as well. Okay, so Murrey wrote a book, and it was well over close to 300 pages. So this particular presentation is going to be really a condensed version of a lot of the key points about Murray math and the Murray math lines, and then how we can actually use it. Okay? So we will go through a little bit of background here, and it's always good to have some context along those lines. And then we'll get into the structure of the lines and then into some examples. Okay? So before we do that, of course, we have to go through the industry disclaimers, and simply the NFA compliance rule 2-29 simply means that hypothetical performance results have inherent limitations. Trading futures and derivatives on futures, all right, involve substantial risk of loss. Right, past performance is not indicative of future results. So everything that you'll see here, basically, in our presentation today, okay, we're not going to take as gospel, but we're going to, know that there are limitations to everything that we work with, but we work within those limitations, and we can succeed, at our objectives. All right. All right, so let's give you a little bit of background and some of the basic assumptions that we need to have in order to move forward with this Murray math stuff. So T. Henning Murray, i.e. Murray math, of course, was born in 1942 down in Nashville, Tennessee. What he did is he studied W.D. Gann's work. And W.D. Gann's work is not something that is easy to read through, if any of you had any experience with it. He was very elusive of, kind of giving the magic formula of how he traded and viewed the markets. But he did leave some traces. And Murray was astute enough to be able to identify and get some of the clues. And it's called fractal geometry. What simply fractal means is that you can take, any chart and break it down into its subcomponents, all right, smaller and smaller or larger and larger. And as long as you don't know the size of, the time or the price or anything else, a chart on a monthly or a weekly or a daily looks exactly the same as an intraday chart. You would never know the difference. So that's the idea of fractal. And of course, geometry is the study of certain patterns, geometric patterns. So what he did is he translated some algorithms of the fractal inside a cube of base 10. Now, if you want to look up what the cube of base 10 is, you're welcome to do that. It's beyond the topic here today. All right, but he translated it into the fractal nature using Fibonacci ratios, but set to the scale of music, an octave. And this is why using these Murray math lines, and you'll see we talk about 2/8 and 8/8 and 7/8 and so forth. So the main assumption was the markets behaved in a herd-like manner. You've probably heard that before. And then the markets are always in a perpetual state of chaos, seeking equilibrium. And you've heard me say many often times during the day that the market's two main functions are to find extremes, okay, and find balance or equilibrium. All right. So W.D. Gann here he was purported to be a brilliant trader. I don't know if that's true or not. Right. But his techniques that he used were, as it shows here, complex, and that's why a lot of people scratch their head, but they all agreed that, this guy knew what he was doing. But they were all trying to figure out what the hell he was doing, and he had a difficult time doing that. So T.H. Murray, i.e. Murray math, I think his, history will say that, his greatest contribution was simply a creation of a systematic geometry that described the market's movements over a period of time. Again, that's what he uncovered through Gann. So the geometry facilitates all the Gann techniques, and it works in harmony with what are called Gann fans, Gann angles, all right, and other tools that you can use. And again, in subsequent workshops, we will present to you some active techniques. Today's workshop is primarily introduction, so we all have an idea of what we're talking about. All right, and the system can be used in all tradable instruments. Does not matter: stocks, bonds, futures, index, commodities, all right, and the such options, etc. All right. So before we get into it, we need to have some basic components and principle understanding. So again, it's fractal geometry is the foundation. We spoke about fractals. Another way of putting that is basically a chart is a chart is a chart. All right, so any chart size can be viewed and measured and studied the exact same way, and that's what makes it pretty neat, because a lot of people get hung up on the chart sizes and so forth. Bottom line is, an ABC pullback or type formation or a right angle triangle is the same. Doesn't matter whether it's on a monthly chart or an intraday chart, and it's viewed the same way. So as long as it's like reading a sheet of music. All right, once you get the core basics down, you can read a variety of different music styles and songs and so forth, but you're going to be able to read it. So it's very simple, whether you're a jazz, whether you're classical, heavy metal, you're going to look at that music sheet and you're going to be able to read the same, because it's all the same. All right. So basically, the overriding principle is simply the recognition that there's a market trend, and we want to trade in direction of the trend always. We do not want to counter trend trade. It does not matter whether you're a day trader, whether you're a hedge fund trader, whether you're a mutual fund portfolio manager. Where we all make the majority of our money is in trending conditions, and we want to be on the side of the trend. All right. And another principle is, as we're building in profits, we want to take systematic profits out at designated levels. All right. And again, the idea here, since especially intraday, where we're trading primarily intraday, what appears to be a trend on a very micro chart is really nothing more than a sideways move on a larger chart. So I don't really refer to trends intraday as trends. I refer to them as a directional move or a progression in price. And again, that progression can stop, fairly abruptly, as we saw, especially today, we saw in the NASDAQ. All right. So the Murrey mass geometry is pretty it's pretty elegant, as they say here, in its simplicity, but it's pretty powerful in its application. So, and of course, according to Murrey, he says it's a perfect mathematical fractal trading system. And the more I've learned about it over the past 6 months myself, I'm tending to agree with him. I'm seeing things in this that I guess I always knew were there, but now it provides a framework for me even more. All right. So if you want to learn more about the fractal geometry, there's a book out by Heinz Otto there and Dietmar. So the science of fractal images. But again, let's just get right into it. And this is try to get into the fun stuff. So these are some of the core levels of the octave that, or in a sense, notes that you want to be familiar with. All right. You'll have a recording of this, and you'll be able to, study this a little bit more. But basically, it goes from a 0.8 to an 8.8. All right, top of the range or bottom of the range, and in increments of an eighth. All right, fairly simple. But when you think about this, let me go back to what I've mentioned before about framing out the market. So the three primary levels that I've always spoken about is the high, low, midpoint. And then the uh, quartiles, the upper 25 and lower 25 and upper 75, lower 75. So when you really take a look at the octave scale here, starting at 0, it's 0, 1/8, 2/8. Well, what's 2/8? 25%. Right? What's 4/8? 50%. What's 6/8? 75%, and then the top of the range. All right, so I'm basically splitting the market into quartiles. What the octave scale does, it gives you the eighths, the odd eighths sequences, and then the overbought and oversolds, which is the minus, plus 8, and 2/8. So you can read what descriptives we have, get to know them. All right, that will be your job there. We'll discuss the ideas about when price reaches those levels in additional slides here. All right, so we want you to get familiar with what they look like, and of course we have created a lines for everybody in our software. All right, it's all part of the software, and again we've used the convention here of the labeling. So for instance, a 6/8 would be a pivot reverse, whether it's a 2/8, which is the opposite to the downside. All right, so that's a pivot reverse, etc., etc. So what you want to be focusing primarily on, you say, okay, we have all these lines. What are the most important lines? Remember this, the most important lines are the even numbers. 2/8, 4/8, 6/8, 8/8, 0/8, and then the plus or minus extension 2/8. Okay, those are the most important. Now, because those lines tend to get hit more often, that doesn't mean the other lines in between are we can disregard, right? But keep in mind those are the key ones. Okay. All right, so I want to give you just some general guidelines, and again, these are general guidelines, so you have an understanding of when we're looking through, the scale here, and as prices are moving around. Okay, we'll show you some examples of these too. So the first guideline is we talk about the idea of equilibrium. Okay, and again, this is a concept in market profile. All right, 68% of the time, market's going to be trading, that's your value area. Okay, so you can kind of relate some of this stuff very similarly. Guys, there's a lot of connectivity between concepts in the marketplace. All right, so all markets want to trade inside the trading range of a 3/8 to a 5/8 on the Murrey lines. 3/8, 5/8, 43.75% of the time. That's basically balance, if you think about it. Okay, that's kind of like the value area. The value area here is defined within the context of 3/8, 5/8 zone, and we'll show you that. It's also called the top of the trading range and the bottom of the trading range. Okay, but it's basically what it means is in the center of the center of the market. Okay. If the market gets above the 8/8, the upper 8/8, right, or the lower 0/8, and cannot break out into the next octave, right? So we'll show you how that works as well. But basically, you have 0/8, that's your primary octave for the day. If it can't break out to the next level or next octave, the anticipation is, or the expectation is it will come back down into the trading range and try to balance out over a period of time. How much time? All right, again, topic for another conversation. All right, but if it cannot, just understand, if it can't break up through the upper edge of the range, all right, it is more likely to come back into the range. And by the way, these concepts are nothing more than things that we've already discussed over a period of time. But what the lines, I believe it does, it actually provides a level of physical context, all right, that you can actually see. Whereas maybe in the past you had some idea about it, but you were not able to actually see it. We've received a number of comments from our members since we started, working with these more and more, that members are beginning to actually see what's happening in the market where they were not able to before it. And that's a breakthrough for many. All right. And of course, that's a challenge for any educator out there, such as myself, trying to get across, topics and concepts. So if this helps you in any way, which it has for many, great. I mean, that's what we're, trying to give you ways of viewing the market so you understand it. The market is not really mysterious, as many people sometimes seem to think, right? And it's very structured, and so this provides that overall structure. All right. Now, in terms of breaking out above the 8.8 or failing to, or back to the 0.8, right? Markets go down faster and harder and are more negative to the downside than they are to the upside. So as such, when prices are moving down to the minus, or excuse me, to the 0.8, which is the lower end of the range, okay, they may not always trade back deep into the range. In other words, back to the middle. All right. They may only, especially if there's more of a hard sell-off, the markets will tend to expand the range down, and the bounces, any bounces or any retracements will be rather fleeting, and so you'll only get perhaps, a bounce, a 1/8 level or a 2/8 level back up. When we talk about eighths, we're not talking about price, an eighth of a point or 2/8 of a point. We're talking about the level itself, and that level could be an eighth differential between levels, could be 5 points or 10 points. Okay, so just keep that in mind when we're talking about eighths. We're not talking about an eighth of a point. All right. So what we're gonna pay attention to is when prices break outside of a 3.8, 5.8 range. All right, what does that imply? What does that mean? What's the assumption? What can we be looking for? Okay, so here are some additional guidelines in terms of the long side of the market. All right, so we have best odds potential. All right, when price comes down and holds the 1/8 line, 1/8 mm. Okay, so you picture a pullback, holds the 1/8, doesn't really blast down to the 0.8, right? And it holds a pullback off of that, and that usually offers a good potential where we can move a 2/8 level or 2 line level. Second odds are 0.8 to or the 2/8 mm line. Okay, and then if the price does get deep extensions or below the 0.8s, all right, the -1/8 or the -2/8. Now there are specific odds to those, 75% and 95% odds of a snapback. So what these -1/8 and 2/8 levels represent is deep extremes. Market is really quote unquote overbought or oversold, and there's a pretty good percentage that the market's going to snap back. All right, and it can snap back. It's like stretching a rubber band. It's either going to break and go into the next octave, and the whole octaves will shift down to or up to the next level, or it's going to reverse back, and these usually offer some very good potential. Okay, but typically what you want to do is stay in the range of the octave, but at the low end of the range. All right, and then look for buying opportunities, signals, discounts, premiums, order flow variations, divergences, things that we typically look at, right? So remember, these are all levels, all right, that we want to be referencing throughout the day, and then the actual trade technique, entry, management, etc. Again, is part of the method, and you employ whichever one you want. On the flip side, just to look to the trade short. So again, to the upside of the market, And by the way, these work best, or let's just say, if you want to fade a level, all right, what I'm really getting to here, if you want to fade a level, it really works best when you can identify the market type. So for instance, if the market is in a range day, type day, okay, and the market pushes up to the 7/8 line, you want to look to fade that. You want to look to short that, of course, with the proper signals, order flow, etc., that you're using, but you're looking to short that in a range day. You don't necessarily want to short a 7/8 in a trend up or trend down day, okay? Because the momentum there could blast simply right through it. So you don't want to be counter trend trading. But in a range day, certainly it offers very good potential to fade the markets, right? And so that's something that you want to be aware of. Again, the context is always and will remain always important. Of course, the second best will be the 8/8 or the 6/8 lines. Again, visualize a range, okay, between the lines. And then the same applies for the +8s and 2/8s. As you saw today, I was looking to sell the +2/8 on Nasdaq, and it came within a tick of the line. We missed my offering limit order, and it went, snapped right back down about 15 handles. So I was a little disappointed that one, but we had the right idea. I just didn't get the execution for us. Now we spoke about the 3/8, 5/8 range, the middle of the range, right? Many of you know I deplore the middle of the range. I hate the middle of the range. There is little to no edge in the value area, except for scalping. Okay? There is no range expansion. Things are balanced. It's not the best place to initiate trades. All right? If you do, you have to adjust your expectations. And I know many of you like scalping, so if you're within the 3/8, 5/8 band, and I'll show you an example of that today with the S&P. Just consider, scalping it. All right, so you're not looking for two-level, profits. All right, you're basically, taking just shorter triggers. Okay, and profits. All right. Okay, so on the next slide, this is kind of a graphic illustration. All right, of some buy and sell options of how the swings can unfold. All right, this is just an example here. All right, so as we spoke about in the best patterns, by the way. Okay, let me just make a point about something. The best patterns that you really want to look for, all right, are these 1, 2, 3 type or ABC style patterns. Okay. And what we're really referring to is, this type pattern here, where you're coming off of, say, a deep low. This is your 0/8, okay. And again, we don't have extensions. It's just the simple octave 0/8 to 8/8, and then you move up to, whether it moves up to 2/8 or 3/8. Again, you'll have to measure the swing, but price will typically stop at or near one of these lines, and it does so, consistently. Now, this particular diagram, keep in mind, you'll notice that it hits the line perfectly and stops and reverses, and hits the line perfectly and stops and reverses. Now, in real life, this is more of a template and an example, but in real life, there's plenty of overshoots of the lines. Okay, so I always say that take a line value, whatever it is, and plus or minus a couple, points around the line to adjust for any potential overshoots. All right, so in real life action, overshoots occur. All right, but the pattern that you really want to kind of trade is these pullback patterns. Okay, where, all right, it's kind of this 1, 2, 3 or ABC type pattern. right? And then that's where you want to look to enter. And many times it's going to be at or near a Murrey line. Now, a lot of times what will happen is it will go up, you know, it will go up 1, 2, or 3 Murrey lines. So you want to take about 50% of that. So if it's gone up, say 2 Murrey lines, all right, you're going to look for a pullback to a lower Murray line, which is somewhere going to be around that 50% mark. So again, think about, you know, for those of you that like Fibonacci's, all right, don't get too caught up in, you know, 61.8, a perfect Fibonacci. Think about 50, 25, 75, all right. When you're trading, you want to keep things simple. All right, you don't want to be bogged down in measuring every little bob and weave, right? And what you'll find is you'll get to know and recognize the patterns, okay? It's like sheet music, all right? You'll eventually see the same patterns over again, and you'll be able to read them, you know, at a clip. It takes some time at first, all right? But what you want to do is you want to be looking for these 1, 2, 3 or ABC type patterns, and many times it'll be ABCD or ABCDE, you know, depending on how far it goes up. But what you will find is you'll find that the markets will tend to have a tendency, right, to stop and pull back or reverse, right, at or near these Murrey lines with regular consistency. All right, it's almost scary sometimes that that many times it'll stop, you know, right on the line. I will say to you that, you know, over my years of experience working with the investment banks and various algorithmic programmers, there's a number of algorithms I'm confident of that are tuned into, you know, Murrey levels. All right. Remember, the market's natural harmonic sounds and vibrations are what they are. And, you know, again, professionals, you know, whether they're an algo high frequency firm or mutual fund, they're all essentially tapping into what the market harmonics are all about. So again, if you intend on playing this type of game, you have to learn what the market harmonics are. All right, you got to learn how to play the instrument. All right, doesn't mean you have to be as good as they are, but you have to have a level of competency. And what we're trying to give you here is a template and an outline. All right, and this is not just theory. It looks great on paper here, but we will show you how it actually does unfold on a day-to-day basis. Okay. All right, let's move on. Just another graphic here. Now, this particular graphic shows us that many times if price is above the 5/8 line, all right, and falling, okay, so above the 5/8 line somewhere and falling, it will generally stop and consolidate somewhere near the 5/8 line. Remember, the 5/8 line represents the top of the value zone, or if you think about the value area. Okay, so it's similar to that. All right, and the same is true in the opposite side. So if the price is you know, below the 3/8 line and rising, right, rising back up, it's usually going to find some resistance around the 3/8 level. Again, lower value area, type area, all right, middle of the market. And why is that? Because there's a lot of clustering of activity generally in the middle, and if the market has expanded outside, all right, of that middle area has a lot. Again, it's almost like you know, a magnet. Prices are being drawn in and into that magnet. So something to, you know, to keep in mind. All right, and remember that the 3/8, 5/8 levels, you know, 43.7 or so. So just remember, 43% of the time, right, the markets want to trade in an equilibrium area. All right. So, you know, before it jumps back outside, it, you know, that's what's kind of considered a comfort zone, right? That's where all the big boys can do to do business, All right. So a lot of times when it's outside of that area, it needs to come back and test to see if that level, near the 5/8 or 3/8, all right, if it's okay to stay outside that zone, or does it need to go back into that zone? So again, we talk about the market probes, right? Looks for extremes, looks for balance, but at some point the market does shift bullish, bearish, and moves to the next level. So if there's a lot of consolidation between the 3/8, 5/8 zone, i.e. the balance zone, equilibrium, once it moves outside of that, it generally is going to test it. And this is just what the market does, and then it moves on higher or lower. All right, so something to keep in mind, and that's why it's important to understand about the the balance area, and that 43% of the time it typically hangs out in that area. But now when it gets past the 8/8, either to the upside or to the downside, all right, so you get some mirror images there. All right, if the price moves above the 8/8, say for instance, 75% of the time the price will reverse off the plus 1/8, or of course minus 1/8 to the downside, and then retest the 8/8 again before moving higher. Now again, the reason why it's moving above the 8/8 is because there's momentum associated. Remember what we said short time ago? That if the market comes back and fails at the 8/8 levels or the 0/8 levels, right, the markets will tend to pull back into the range. Well, what happens when it gets above that level? All right, it's again, it could be a failed breakout, but the assumption is that the market has enough energy to move beyond the normal octave level, and when it gets to that, generally gets to that 1/8, all right, 75% of the time it will move back down and test the 8/8 level. So that, again, 75% is a good odds, if you think about it, to look for a trade there. That trade could be worth 5 points, could be worth 3 points, could be worth 10 points. I mean, again, depending on how wide the range is on the instrument that you're trading. Okay, could be 15, 20 cents on crude oil. I mean, again, that's a good trade. All right. So think about that. All right. Once it gets above the 8/8, ask yourself: is it expanding the range? Is it failing to get back up? Is it failing at the top end of the range? Remember the 7/8. If it stops at the 7/8 or the 1/8, it's usually a pretty good sign that the market may reverse back up to the 3/8 or down to the 5/8. All right. So whether you're talking to the upside or the downside, they're just mirror images here. And then, of course, if there's enough energy to move higher to the 2/8, 95% chance of the time, all right, the market will reverse down. So this is really an extreme level on the scale. All right, that's like somebody's screaming at the top of their lungs. All right, they can do it for a short period, but they're not going to be able to sustain that. So in this case, the expectation is a pullback from the 2/8 back down to the 8/8. Okay, and again, in sort of rhythmic swings here. All right, so those are some of the things you want to ideally pay attention to. Now this is just another graphic, hopefully just to kind of give you a sense of we were talking about if the market holds the 1/8 level, right? It has pretty good odds if it holds the 1/8 level. And notice here, 1/8, right? It'll rally up. Usually we'll find usually wants to get back into, near the balance area if it's holding the 1/8 line. All right, and then from there, again, if the market rejects it, right? Again, we got to take it one step at a time. Again, this is just a template to show you the rhythmic nature of how the markets move back and forth between these levels. Right, and again, does it with a fair amount of regularity. All right. Now we talked about, again, if you take a look at as an octave here on the music scale. All right, I threw in a picture of a music scale. All right, and how the markets kind of generally will play a certain type of song, in a sense. All right. So there's a lot of good relationships that goes on with music, and for those of you that are interested, there's a lot more you can learn about that. But generally, the market, I've always talked about that the market has its own song, in a sense. So if you were to actually, plot specific notes and quarter notes and half notes and all this other stuff in variety of different chords, the market will actually play a song. I've never done it. I don't know if anybody actually has, but this would be kind of an interesting project for somebody. All right. So let's take a look at a couple snapshots here that I've created over the past couple days. And this was one from yesterday in the NASDAQ. And this was during our live trade action. So this is our indicator that we've created. And as you can see, it has the same labeling convention on it. The major SNR here in the middle, that is a 4.8. Top of the range is a 5.8. Right, then 6.8, then 7.8, then ultimate SNR, an 8.8, and then a plus 1.8 and a plus 2.8. So we refer to them the extreme OB 75 and extreme OB 95, and same to the downside. Now, what you want to note here is that's great. You got a whole bunch of lines. All right. Well, somebody said to me once, you throw up enough lines on the chart, it's going to hit one of the lines somewhere, right? And, if you view it that way, then, it's kind of a short-sighted, view. Okay. Okay. Yes, it will be recorded, so we'll get that recording out to everybody, as soon as we can. All right. Have a great evening. All right. So again, if you view it that way, you're rather short-sighted. So keep an open mind on a lot of this stuff, and think about what the odds are. So when we get down here, to the low end of the range here, for instance, okay. So what are the odds that if we get down to the low end of the range here, right? Okay, at the extreme, there's 75% chance that the market's going to reverse back up. Gets down to the minus 2.8, 95. All right. So when it gets down to these levels, you sit up and take notice. All right. I mean, you think about, there's a lot of this particular market. Now, this was NASDAQ. All right. Now NASDAQ went from, extreme to extreme. All right. Now, there were opportunities to, to sell up there, and, vice versa. And then also along the way. All right. So you can see how the market went, down, it bounced up. And again, in real life trade, not template that I was showing you, the markets will overshoot these lines a little bit, okay, many times. Don't say, oh, it doesn't work. It does work. Just be flexible. To be a good trader, you need to be flexible. Also, you need to have very good risk management, okay? Now, if you take a look at these particular lines, right, they're about 10 points apart. 9 points, 9.5, almost 10 points apart. So when you take a look at these, you say, wow, that, they're little, well, when you, in real life, they're 10 handles apart. So remember how I talked about that the market is fractaled, right? So if you take a look at this is a little bit more of a bigger picture chart, but in between, say, for instance, the stop and reverse level here at 55.75, and then the 46s. All right, which is the pivot reverse. So that's a 7.8 and a 6.8. So if that's roughly 10 handles, all right, intraday when we're trading this, you can actually subdivide all right, these levels, and again, pick out a midpoint. So if you were to go ahead and say, let's for instance pick out a midpoint, you may be able to be pointing to somewhere, above that line or below that line, and have a trade opportunity there, and then have a requisite stop. Okay, in Nasdaq currently with the volatility as of today, anywhere from 5 to 7 points per contract is probably what we need to say, to be safe. But remember, we want to trade in direction of the trend. So if the trend direction, okay, is down, okay, well, I don't want to be fading a Murrey line. I want to be looking for the retracement back up near a higher Murrey line. All right. Also, keep in mind, is there an ATR there? Use some of the other tools that we have, right? The structure lines, fair value zone. All these things will come into play, all right, as you kind of layer the markets. Okay. The pattern that we look for here, right? The pattern roughly that 1, 2, 3, right? Type pattern. Okay, so you got to move up off a deep low. Actually, it was a double bottom test there, and then you moved above the +2.8, almost to the 3.8. Right, got rejected. Remember how we talked about it gets rejected near that middle zone. All right, and then here in kind of like an ABC type pullback pattern, it found a higher low. So that 1, 2, 3 type pattern, whether it's on the micro scale or a larger scale, again, this is where, and we'll guide you guys, by the way. I mean, my job, is to help guide you to look for these. What I want you to absorb in this particular presentation is the fact that these lines get hit regularly, and it's not just happenstance, but it's more in tune of what the market does harmonically. Okay, that's really the important takeaway here. And what the market and what these lines are showing you, these are calculated daily for you, all right, based upon the harmonic vibrations. So you don't even need to know what the harmonic vibrations are. Okay, like if you're learning how to play guitar, all right, as long as you recall a certain song sequence is 7/8, 8/8, 3/8, 5/8. 7/8, 8/8, 3/8, 5/8. Repeat that. 7/8, 8/8, 3/8, 5/8. All right. So you're strumming your strings, and you're putting your finger on the string, and 7/8, 5/8, 7/8, 3/8, whatever it was. All right. And you remember that. So you remember that the market hits certain levels over and over again. All right. And the market tends to respond in certain ways from those levels. All right. And then again, in repetitive nature. All right, so remember how we talked about that the 3.858 zone, 43% of the time hangs out there. Well, this is a real life example today of in S&P. All right, throughout the day, top and bottom of the range. All right, and 43% of the time the price will trade between the 3.858 or the balance zone. But notice what did happen though. All right, before. The market finds extremes. I'm telling you this, guys, over and over again. I've been doing this for years. All right, I was part of the process of trying to find those extremes. All right, the market finds extremes. Okay, so here's a 1.8. All right, that's the weak stop and reverse, the ultimate SNR. That's a 1.8 down here at the low. Okay. If you recall a prior slide, we identified a 1.8 as having high odds. All right, because it's at the low end of the range, but it has not broken the range. So it has high odds of finding support at the low end of the range. Okay, so of course you see, what happened there. And then when you get to the extremes, all right, we got 95% chance that the market reverses off of the overbought extremes. Again, this is not happenstance. But along the way, you'll see that the market will trade and consolidate at or between some of these levels. All right, you see this over here as well. All right, stop and consolidate. 6-8, 7-8, 7-8, 6-8. Now, in this particular case in S&P, we're only talking about 2 points. Unlike the NASDAQ, where each of these levels represented almost 10. All right, so each instrument's going to have its own harmonic vibration, but these are tradable, very much tradable. Okay, very much. And when we get into this 3-8-5-8 zone, all right. Now, one thing we always talk about before we get there, all right, prior resistance, okay, all right, prior resistance becomes what? Future support. Okay, so keep in mind where the breakout levels are, or the break points. Again, prices will come back and retest. It's just what the market does. I can't necessarily tell you why, but that's just what the market does. It needs to confirm support or resistance. And when it's satisfied, that's when much of business can be done commercially with the big mutual funds, right? Rotating out of certain stocks, rotating into others. And again, it finds a level of acceptable, balance. But it's during those periods that if you're going to trade a level of balance, what you want to do, just like most all the times that we want to do, is we want to look for the levels of extremes, right? The low edges up here, okay, or the upper edges, in that area, whichever, it is, maybe, again, identifying, Murrey levels, an MM line, right? Very clear on our charts now, right? And it's just a matter of, you basically doing some work, all right, along those lines. It's not that difficult, but basically doing some work, okay? We only have a few more minutes here for the presentation. I don't want to go over more than an hour, but let's just take a quick look-see, all right, at some of the charts from today. Okay, everybody should be able to see the S&P chart, which I just showed you. All right, and again, as you can see here in the extended hours right now, again, prices, came back up and moved up. All right, moved up here. They tried to break it out at the end of the day. I was a little cautious about that. Having the market spent most of its time, in that 3-8-5-8 zone. All right, that was not the play. And let's go over to, this is crude oil. And again, things that you want to recognize. Now, of course, this is a downtrend line here. We have a tool, and what we'll do is the Andrews pitchfork, the median lines. What we'll do is we're going to spend some time on another workshop on giving you some more practical application of the tools that we can use, all right, along line with using the MM lines, okay? So one of the good tools, pretty straightforward, but it can really help give you a sense of what how far price has gone down or up, the trend, the direction. Now, things that how I use this, and it's, you could say, okay, well, there's, a bunch of lines there yet again. What we're specifically looking for, all right, are intersections, all right? So let's take a look at this. See this area down here? There's an intersection of a weak stop reverse, so that's a 1-8, lower end of the range, and we're at 150%, right, of the median line here. The median in the middle, 50. It's 150% of that, all right, going out downwards, 100, 150%. Okay? That's an intersection. I'm expecting something to happen at an intersection. I'm looking for something to happen. I want to wake up. I want to sit up, right? You know, take the lazy boy recliner and put it in its upright position. All right, all trade tables to be locked into place. All right, we want to be doing something or potentially there. Okay, now this is kind of a pretty good hit in a reverse. You'll also have near hits. All right, but looking at the lines, okay, the intersections. Okay, again, I'm just kind of pointing them out here quickly. See here, you got a bounce here in this area. Okay, there's an intersection right there. We get the median line. Sometimes they'll overshoot them, of course, right? Nothing's perfect. But what I want to get across here is if the trend is down, direction like this, right? Unless you're at, excuse me, unless you're at real deep extremes, okay, you want to be looking to trade in direction of the trend. Now, again, crude oil has quite a bit of volatility, but the same concept applies. Look for prices, you know, near those Murrey lines, and then looking for them to pivot. Okay, that's going to be where your greatest opportunities are going to be. All right, and then lastly, let's take a quick look at NASDAQ today. And this is today's NASDAQ. All right, we had this was past. Actually, this was today's right in here, the 16th. So we had basically an up move today, although it started compressing a little bit towards the end of the day. But the past couple days, we've had a pretty good volatility here. Okay. Now, again, using the forks, all right, using the low to a high and a retracement back. All right, this was how we basically started the day off. All right, going back 2 days. Again, this is a 750 tick chart, so it's a little bit bigger picture. Going back 2 days at the starting point. But notice as, you know, the past couple of days progressed, right, you should be able to begin to identify levels and stopping points, okay, where prices in fact stopped. Look at this, right, extreme OB there, all right, a pullback, right, to the 6.8 down here, again, an intersection. There was also a pivot there to the left. All right, so prior pivots, right? Again, remember the phrase that I used, look left to know right? So that's something you want to, again, remember what we're trying to do here, guys, is take everything that we've learned so far and blend it in. But what this does, hopefully, it gives us an overall framework that we can begin to see perhaps a picture that was more difficult to see in the past with a little bit greater clarity. All right, here's one here, an intersection right on the median line. So when we have an up move here in the pitchforks, these median lines become this upward sloping. That's a support line. Okay, it's not a moving average. This is all based upon price structure. These are not moving averages. All right, and one of the best things that traders use, right, are price structure, and that's what we talk about all the time. So the Andrews pitchfork, right, that we use here, the median lines, are fantastic for identifying price structure. Moving averages are good, right? They provide context, but they're not structure. This is based upon an actual structural pattern, and the pattern started way down here. Okay. So again, things to, you know, pay close attention to, all right, when you're trading, you're going to be wanting to focus. Here's another one right there, an intersection at the extreme OB, and then look what happened to it after it, right? Price came down, all right, it pulled back. Now again, take a look at the move on that. That's about a 20 handle move, all right? let's see, what do I have a line here? That's about a 20 handle move on there. All right. Now, when we're trading intra, at the granular level, you may have taken or looked to take a short near that level, and look, you may have only traded it for 5 points or 6 points or 3 points or something. But it doesn't matter that, I never suggest that you need to get the entire range of a move. Far be it for me to say that. But what I want you to hopefully appreciate with this and have your eyes open up, that these swings stop and reverse many times right on the number, very near to the number. Little times they overshoot, they pivot. But again, important levels. So determine the trend, as we spoke earlier about in the presentation. You want to trade in primary and direction of trend always. All right? That's important to make sure we're always in the direction. If once it gets to real extremes, then we can look to perhaps fade them. But as with any fading trade setup, again, as long as there's no greater risk, guys, than each trade. If you're going to risk 5 points per trade, let's just say, in NASDAQ, which is $100 a contract, or 3 points, in S&P, which is $150 a contract, whatever it is, the risk profiles don't really change much. The trade opportunities, some have better than others simply because of the overall structure. But if you're going to risk 5 points, either way, do it from or near to or close to one of the key MM lines. Again, along with an ATR, which we saw today. We saw a combination of ATR and an MM line in NASDAQ that worked out very well. So other aspects of our method and our concepts and what we do blend in together. And for anybody that's new, or visiting with us, that's participating in today's presentation, all right, all of this stuff is deeply explained in our membership, okay, in our educational materials. Now, this particular workshop will be uploaded and archived and available 24/7. All right, and if anybody has any questions, all right, regarding anything that we've discussed today, you can always reach me and give me a call. We can set up an appointment or to go over some things that you need. All right, and always send me an email. All right, that concludes our introduction to the MM line / Murrey math for this presentation. We will have subsequent workshops that will then we'll subdivide and we'll actually pull apart some of the actual trade setups that we look for. Okay, so this is primarily an overview, and so now since you've been introduced to this, all right, going forward we'll be honing in on some specifics. All right, so as of today, this is a newly sanctioned part of our methodology. All right, and you're open to trade it every day going forward. We have the indicator already on our platforms, so we're all set. Okay, all right, well, that's it for me for today. Thank you very much for attending. The workshop's about an hour and 10 minutes long, and that's about as far as that I want to take it, about 70 minutes. And thanks for your attendance, and we'll see you guys in the trading room. All right, enjoy the rest of your day. Thanks.